All right, we're 10 days into some rather chaotic trading. We've seen more ups and downs than an elevator. Is that a corny dad joke? Yes. No, I cannot help myself. But we got some major concerns about the economy, the consumer. Will the Fed be too late? We had some soft tech earnings, and then we had Japanese carryout. Sorry, fluffy, can't help myself. Food comes first. The Japanese carry trade. What is it? What does it mean for you? And why is it being blamed for the pullback, which suddenly is no longer a pullback? The last 6 days in a row have been up for the major indexes, and the major indexes are up on the year. So what does that mean for you, your retirement, your goals? Pour yourself a drink, buckle up, and let's get into it. All right, well, a carry trade may sound complex and tricky and all of it. In the big scheme of things, it's actually fairly simple to explain. To execute, that's a different story. With this chart here showing the spread between a 10-year U.S. Treasury and a 10-year Japanese government bond, Japanese rates have been negative since almost 2016. So what people have been doing is borrowing money at a low rate in Japan and then investing it in the U.S. at a higher rate. Our Treasury is almost hit 5. We're somewhere 3.8, 3.9 currently. So the spread between, you're basically making an arbitrage, the carry trade. You're borrowing from one place, investing in another. But last 2 weeks ago, Japan raised rates to a quarter point, and the U.S. is tipping their hand that they're probably going to cut. So the spread is getting narrower, and some people might have been using leverage. And we know leverage can get you in a lot of trouble pretty quickly. So simple concept, borrow from lower interest rates, invest at a higher interest rate. That blue shaded area is you're designed to be your profit. All right, can one reversal of a trade in the global economy cause this widespread panic? Usually not. But what's the guilty party that's involved here? Bring us back to 2007, leverage. So a lot of these people have been doing these carry trades for decades. Interest rates in Japan have been negative since 2016 and just low in general for the last almost 20 years. So what they've been doing for a while is borrowing and investing elsewhere. And it's been working. So just like you on a heater at the casino, you bet, you win. Oh, me increase my bet. Oh, bet, I win more. Oh, I bet and I win more. Me bet more and win more. So they've been using margin. You might have seen the movie Margin Call. That firm kind of blows up when interest rates go against them. Similar thing here. It's been working for so long. They've been increasing their bets, borrowing to increase the size of what they can borrow to invest and increase their total return. Everything works until it doesn't. And with Bank of Japan increasing rates a quarter point and the U.S. potentially cutting next month, that caused a squeeze and somewhat panic selling. And we're not talking panic selling a couple hundred shares. You have massive funds and private equity and just the big trades are getting through, and it just rattles through the financial markets across the globe. So on the flip side, in the last 5 or 6 days, you've seen it kind of, settle in. The dust has settled. The yen is kind of trended back. And you see in this chart, it's actually spiked up and actually kind of like leveling off here a little bit lower. So can one trade really affect the globe? No, but leverage can. And at some point or another, they'll learn from 2007 with the financial crisis. And hopefully this carry trade will remind some people not to lever up so much. All right, this last slide may look like chaos, but it's truthfully just conveying something very simple you've heard me say before. Average market correction, down 14%. Average time to recover on that, 4 months. So the last 10 days, basically it was dog years. We got through it in 4 months, was 10 days for us. That's why it's average. Sometimes it takes longer, sometimes it's shorter. But we're still up on the year. Yes, we're off the market highs, but a little pullback off the highs is perfectly fine and normal. No, it does not mean we're in recession. No, the world is not coming to an end, but it does give us a chance. Check the earnings, check the economics, check your plan. If you don't have a plan, you got to stop. You don't want to F around and find out with your money. Un-F your finances. Give me a call. Let's get a plan in place and look forward to helping you get through the next pullback that we go through together. Have a great day.